I think you look at what the Fed has to do and what the impact of that will be over time. It seems to me that the Fed would like to let interest rates rise a little bit. They'd like to do it so that they have a tool where they can lower them if they need to again. But it's tough to lower them below zero. It's also tough to let them rise. I know that most audiences prefer narrative to arithmetic, but I'm going to give them some arithmetic anyway. If you go back over the last 40 years, traditionally the US 10-year Treasury has had a positive yield over the rate of inflation. If the rate of inflation is 6.5%, then if the Treasury yield was to revert to mean, the US 10-year Treasury would be selling with a 7 handle or a 7.5 handle, which means that the debt service cost throughout society, but particularly to the government, would go up fourfold. I don't think they can do it. But again, it gets worse. Traditionally, the 30-year mortgage rate in the US, the rate that American homeowners pay to borrow money to buy a house, trades at a premium to the US 10-year Treasury. If the US 10-year Treasury rate was at 7, the first mortgage rate would be at 8, 8.25, as opposed to 3. That would give you affordable housing the old-fashioned way, which is to say that the price or the affordability of houses would fall so much as a consequence of interest rates that the real estate market would get crushed. Am I saying this is going to happen? No. What I'm saying is that it is unlikely that the Fed is going to be able to let interest rates rise to any substantial degree, which means that the set of circumstances that's in front of us, unfortunately, probably favors gold for a fairly substantial period of time. Do I know what's going to happen a month from now? No. Do I know what's going to happen 3 months from now? No. Do I know a set of circumstances that's very much more likely to occur than not occur? Yes. And am I able, as a consequence of looking at the probabilities around what has to happen, fashion a response in my portfolio that will much more likely than not reward me over time? Yes. I prefer probabilities or certainties over longer periods of time, rather than psychologically secure, improbable outcomes during shorter periods of time.
The first half of a precious metals bull market is usually all about gold. The second half tends to favor silver more. So I wondered if you could give us a sense of where we are right now, and also maybe give us some historical examples so we can understand what you mean by that.
Some of this now is going to become conjecture, Charlotte. But a lot of life is about conjecture. I've lived through 2 precious metals bull markets in my life, 1970 to 1981 and 2000 to 2011. Both of those were decade-long affairs, in fact, 11-year-long affairs. I believe that the bull market that we're in now probably got underway in 2018. So we're 3 years into a bull market. I suggest that if past is prologue, it doesn't need to be, but if past is prologue, there's probably 7 years to go. So we're probably still in the first half of the bull market. And we talked about before, bull markets have substantial dimension. The gold price now has gone from what, 1,000 to 1,800 US, something like that. And people say, well, isn't the bull market over? I mean, gold's up 40%. Well, first bull market, gold was up 25-fold. Second bull market, gold was up 6-fold. Am I saying that gold is going to be up 3 or 4-fold? No, but it wouldn't surprise me if it was. As we talk too, examining prior bull markets, there is this incredible volatility, these incredible cyclical declines in secular markets, which is precisely what I think we're involved in. I went through one of these in 1975, where the gold market fell by half. I went through another one in 2002, where the market fell by 20 or 30%. So this is not unheralded to me. The other things I've learned about precious metals bull market, and getting back to your question, is that normally bull markets are brought on by fear buyers, and the fear buyers go to insurance, they go to gold. Once gold has established the momentum and the narrative around precious metals becomes more understood and accepted by the market, and the investors and speculators come into the market, which is to say the greed buyers keep the fear buyers company, then the metal with more volatility and lower value per unit of exchange, silver, begins to take over. The second half of the two bull markets that I have been through have been silver-centric. And I would say to the speculators that the most upside volatility that you see in precious metals markets are in reasonably high quality silver equities. The market capitalization around the silver equities is so small that when the narrative begins to appeal to the generalist investor and money flows from the generalist investor into the silver equities, there simply isn't enough market cap in that silo to handle the money. I'm reminded early in my career of things like Silver Standard, which we underwrote at 76 cents, going to $45. Pan American Silver, which if I remember correctly, we underwrote at 50 cents, going to $40. The bull market before that in the 70s, Coeur d'Alene going from penny dreadful in Spokane at 10 cents to $65. The upside in reasonable quality silver stocks in a silver bull market is truly insane. Unlike anything that, well, I guess I've seen it in other instruments like uranium stocks and in crypto. In the uranium stocks, I understood it. In crypto, I don't. But I can say among the classes of investment and speculation revolving around precious metals, that for speculators, the silver stocks have incredible upside. I've been talking to them a bit because part of my audience is attracted to me because of the call I made on uranium a couple of years ago. It's interesting that when you and I were talking about uranium, as I say, 3 years ago, nobody cared, and now everybody's fascinated. And what I want to say to speculators is, yes, there's more room to go in uranium, but the market's affinity for silver now is where the market's affinity was for uranium 2.5 years ago. To be a successful speculator, you got to hit them where they ain't. You got to buy assets that are unloved. You can't get an asset that's loved cheap. And so in terms of sentiment, silver is where uranium was.
Right. And, silver has, I find, a really dedicated base, but also a group of people who have faced so much pain. And we had that hope at the beginning of the year with the silver squeeze that's kind of dwindled off. For you, would you say that's kind of still going on? It's just the beginning and we'll see it rise again?
I think we will see the real silver squeeze in front of us. The silver squeeze that we saw was very interesting. And I got to say, I was taken by surprise by the amount of physical silver that was bought by newcomers to the silver market. It was incredible to see the amount of silver that they bought. But that isn't what the real silver squeeze is about. The real silver squeeze is simply about the market share of precious metals returning to their historic means. It's about university pension funds, state pension funds, and insurance companies going from having no precious metals in their asset hoards to having 2 or 3% in precious metals. When that happens, Charlotte, and I really think it's when, not if, when demand for precious metals merely returns to the prior means, I think then you see demand for precious metals triple. We may have seen as a consequence of the silver squeeze a 10 or 12% increase in demand for silver in the United States. Relative to supply on float, I think we're going to see demand triple. That's 300%, not 10%. And when you have a 300% increase in demand with no concomitant increase in supply, because you can't increase supply that much, the price action can be very, very dramatic. So I think that the silver squeeze that we saw was an interesting phenomenon. It tells us that the way the world invests and speculates is changing. That information doesn't need to come from Chase Bank or the Wall Street Journal. It can come from Charlotte McLeod. There's distributed information and distributed response. That was the message of the silver squeeze. But in terms of its impact on the silver market, there wasn't much. What will make a difference in the impact on the silver market is when we get away from the Reddit crowd and we go to, Ontario municipal employees, TIA, CREF, the biggest institutional investors in the world, when they begin to return to precious metals markets. as they had to do as responsible investors in the latter part of the 70s, I think then you see the real silver squeeze.